Thanks for joining us for Want to Know Wednesday. If you like the video, please like the YouTube channel. Every single Wednesday, 4:30 Central Standard Time, we are dropping a Want to Know Wednesday video. And give us some feedback, leave us some comments. What do you want to know? You ask it, you want to know it, we want to deliver it every Wednesday at 4:30 Central Time. Today we're talking all about earnings in a business. Net operating income in real estate, or earnings if it's a different type of business. There's a little bit different language between real estate and business. I'll kind of cover both of them and what the power of, let's just call it $1 million of earnings is in real estate or a business. Obviously, if you're a 1099 or if you are a employee, and if you get $1 million, you're going to be taxing that $1 million. 50% of it's going to go to the government, right? So you got $500,000 left. What people don't realize is when you're building a business and you own the asset, whatever money you have left at the end of the year, be it $1 million, yes, you're going to pay some tax and whatnot. And depending on real estate, we don't always pay tax on our real estate. But the value is going to have a multiple or a cap rate attached to those earnings that then actually put the value of that $1 million, not at $500,000 like if you're a W-2 or 1099 employee, because that's the net after taxes, but it'll be a multiple or an inverse multiple of the earnings, which can give you, it can turn $1 million of profit from a year into a 15 million, 10 million, 5 million, 20 million, $30 million valuation. And that's the valuation of that cash flow getting thrown off from the business. Therefore, the business is worth much more than just 1 year's cash flow, right? And why is that? Is because usually businesses, they're self-sustaining, right? So the person that buys a business, you're going to pay a higher multiple or a lower cap rate, which we're going to talk about in a second. You're going to pay a higher multiple or a lower cap rate the bigger the business is, with if it has more infrastructure. If it's a one-person show, you're going to pay maybe a 2 multiple or a 1 multiple on the earnings, versus if it is a 1,500 employee enterprise and they have significant scale in the space, you're going to see maybe a multiple of 10, 15, 20. Right now in real estate, depending where you're at, you're going to see cap rates. Cap rates can be, right now, cap rates can range anywhere from 3% to 7, 8%, depending on location, the type of property, and whatnot. The cap rate is an inverse multiplier. So you actually take the net operating income and you're going to divide it by the cap rate. Right? So a 5% cap rate, if you do the math, and we're going to walk through some of this stuff again. I'm talking through it right now, but we're going to walk through again so that we can catch you up and get you taught up on this stuff. The cap rate's an inverse multiplier, right? So you take the NOI, right? And how you get the NOI, how you get earnings. NOI in a piece of real estate, earnings in a business is all revenue that comes in from that property, from that business, all expenses, all operating expenses that go out. From that get subtracted, and that leaves you with your profit, that leaves you with your net operating income, that leaves you with your earnings, right? Now, EBITDA is earnings before interest, taxes, depreciation, and amortization. EBITDA is essentially what is used in the business world. If you're buying a dental practice, if you're buying a veterinary practice, if you're buying a painting company, a property management company, you're going to get you're going to get a multiple on the EBITDA, right? With property, you're going to have revenue, you're going to have expenses, you're going to have what's called your net operating income, right? And your net operating income is also not including any interest that you pay for the mortgage. That doesn't include any principal you pay on the mortgage. It doesn't include the amortization, the depreciation. It's before those things, right? So now your NOI is what you're going to take divide by the cap rate, and then you're going to get the value of your building. So again, both EBITDA and net operating income, NOI is short for net operating income, both EBITDA and net operating income is the equivalent to revenue minus expenses. And the expenses are only operating expenses. They are not your mortgage. They are not any taxes. They are not including depreciation, amortization, right? So it's just the normal operating, day-to-day operating expenses. You've got a cap rate for real estate, right? You always hear cap rate in real estate. You rarely ever hear earnings or earnings multiple, EBITDA, multiple of EBITDA, right? And then on any other type of business, you're usually seeing EBITDA, right? Which is a number, or it's stated as a multiple. So cap rate is always in percentages. Again, the cap rate might be 3%, 4%, 5%, 10%. And the EBITDA is always a number. It could be 2.5 times EBITDA. It could be 20 times EBITDA. It could be 10 times EBITDA, the valuation. So right down here, NOI, right, of $1 million on a piece of real estate. The cap rate is 5%. You're going to take $1 million and you're going to divide the cap rate. Again, cap rates are inverse multiplier. You're going to divide the cap rate and it's going to be 5%. So 1 million divided by 0.05 is a $20 million value. So when you actually do the math on this, you know, obviously $1 million goes into 20 million 20 times. So the multiple on a 5% cap rate, the actual multiple here then would be 20, right? So if you have a business that is, again, a 20 multiple on a business is not super common for people that might be watching this video, but it's common, you know, if a company is huge, right? So we're talking scale. You get a 20 multiple, all right? You have an EBITDA of $1 million, 20 multiple. The value is $20 million. So now think about this, right? There's so many people that are in it for the short buck, right? What's it going to do for me right now? What's it going to do for me this year? And they run their business, you know, just focused on like the cash they can pull out, right? But if you can make investments back in to grow your company and get a higher multiple, a lower cap rate, if you can do that, look at what your actual $1 million of yearly earnings can be valued at if you go and sell and transact a company. Now again, a smaller company of like 30 employees, 40 employees, depending on the sector or the industry, that could be a 2 to a 7, 8 multiple, maybe sometimes 10, 11, depending what industry multiple. So not all, a 20 multiple is not always, you know, something that's seen, right? So again, cap rates are an inverse multiplier. Now, something to think about here is if you're looking at buying an asset, a business, when might you overpay, right? Well, so sometimes you'll see these values and people will, a broker or a seller might give you a certain value, and it might be you might view it as a great deal, right? And so you might view it as a great deal from the standpoint of, okay, maybe this multiple is a little bit higher than the industry standard, but if there's still a lot of meat on the bone for this business, meaning you can raise prices, you can expand, it's already trending upwards, the industry that's trending upwards, you might be willing to pay a 20 multiple for that company. So you might overpay. Some people will view it as overpaying. You might overpay because you know that once you run it, you can actually raise this value relatively quickly with a few things that you can do. Again, charging the right prices, better marketing, more efficient flow of the business in the day-to-day practices, so you're not wasting as much time. Maybe you can find a way to save material, right? So this 20 multiple, even though the other industry, the other companies, the other comps might be selling at a 15 multiple, maybe you're buying at a 20 multiple because you know there's a lot of low-hanging fruit that you can go capture relatively quickly with what you consider to be relatively low risk, right? So you might, quote unquote, overpay based on a multiple, quote unquote, overpay based on a cap rate, right? Now, where's this true in our properties where some people view us as overpaying, right? Well, day one or on the trailing 12 months, so the previous 12 months that the seller owned this property, it had an NOI of $1 million, right? We've actually gone and paid 4%, a 4% cap rate on the trailing 12 months of operations, which when you do that actually puts us at a $25 million valuation, right? Because 1 million divided by 0.04 will be 25. 25 million is the answer there. So why would we overpay or pay a more compressed cap rate that would show a higher price? Because we believe that we can actually increase this NOI by doing property upgrades and maybe raising rents 20%, right? Maybe raising rents 25% because they haven't marketed right, they haven't put money back into the property, and we know what we're doing, right? We do all of our due diligence. We know that we can raise NOI, and then when you actually look back and adjust, right? So now after you operate this deal for a while, you can go back and take the new NOI after maybe 3 months or the new NOI after 6 months, and you adjust what your NOI is going to be after a full year because of the simple changes that you made. And you might actually go back and realize, well, we actually made for adjusting that based on the price, based on the new NOI, you can then figure out what your actual cap rate was that you bought at. And a lot of times what we're finding is we'll buy at a 4 or 4.5 or 5% if there's a lot of low-hanging fruit that we can go out and get, right? But then we look back and it's more of like a 5.5, 6, 7 cap rate that we paid for the deal. Even though the market is still
going to sell it again at 5% or 4.5% or 5.5%, we can go back, reflect, and look at what we actually think that we got it for, right? So that's a scenario where, based on cap rate and multiple, you might pay a little bit more, right? You might might have a more compressed cap rate, which gives you a higher price. You might pay a higher multiple than other industry, than other sales comps. Let's put it that way, than other sales comps, if you think you can go get a lot of that low-hanging fruit. When might you want to stay away, or when might you try to underpay or push back on the price, is if, like in this 20 multiple, right? If they have done every single thing to the business like perfect, and you can't add any more value, right? Where really, when you buy it in day 1, day 5, day 30, there's a better odds of you actually being able to hurt things and have the EBITDA go backwards, right? You want to be careful of now overpaying or paying a higher multiple than the market or sales comps, and you want to be careful and not, so a property that's ran perfect, that we can't add any value to, we're not going to want to compress this down to a 4.5% cap rate. We're going to want to go 5%, maybe raise it 5.5, 6% cap rate, right? Because we feel that there's more risk with us taking this on, so we can't actually overpay for the current net operating income, for the current EBITDA. Danny, does that make sense a little bit to you, what I'm talking about?
As much as it can.
It's a little bit of a deeper, but the main thing I want you to get from this video, and you might have to go back and watch this video again. You can keep that part in there. Don't even edit this out for the YouTube. But I suggest you go back and watch this video again. The first main concept that I want you to understand is, and this number could be $250,000, whatever. I'm just using $1 million because the math is easy, right? But this is what's going to go into your pocket essentially each year. Before, so like NOI is what would go in your pocket if you didn't have any debt on the property, right? If you had no debt on the property. Same thing over here, the business, right? What you need to realize is there's more, the actual value here is in the asset, right? So it's not just $1 million of EBITDA. It's not just $1 million of NOI. It's actually a $20 million value, or maybe on $250,000 of EBITDA, because you have a painting company, maybe it's $250,000 a year in cash flow and EBITDA, right? But you could transact that business at a 3x multiple, right? So this number could be, I don't have a marker in here, this number could be $250,000. You might have, let's just say 10 employees, 12 employees in a painting company, whatever it might be, right? The multiple on that might be a 2, right? Or a 3x the EBITDA, right? So 250,000 times 2 is 500,000, right? Times 3 is 750,000. So don't forget that by pouring money back in, by getting scale, by becoming bigger, by being in the right industries, not only do you have an income stream and cash flow, you got to remember what the overall value is here. Now, if someone owns this business 100% outright, right? Think of the net worth statement. Well, your personal income statement is going to show the $1 million that's going to flow into your bank account, right? And maybe it's amongst you and 5 other partners. Maybe it's not just you, but whatever. There's going to be $1 million a year going into your guys' bank accounts from the profits of the company, not from you trading time working there, but from the profits of the company, right? And if it's a 20 multiple, it's a $20 million valuation. That means you increase your net worth, you and your partner's net worth, by 20 million bucks, right? So what happens if you can go buy this thing? What happens if you can go buy this thing for at $1 million NOI at a 20 multiple, right? Or $1 million of EBITDA at a 20 multiple is $20 million. What if you can increase this EBITDA over 1 year 10%, and the next year another 10%, and the next year another 10%, by doing things more correctly in the business, by installing SOPs getting SOPs installed, by raising revenue, by lowering expenses, right? That would take you to 1.3 million times 20 is going to be $26 million, if my math is correct in my head, is going to be a $26 million value. So you paid $20 million for it, but now 3 years later, it's worth 26, right? So that's the power. You can't forget about EBITDA, NOI. You can't forget about these multiples and cap rates. Obviously I'm very cash flow driven in what we do. I'm always talking about cash flow on this channel, right? Real assets that cash flow are great. But in the back of my mind, what I'm also thinking about is I'm just waiting the cash flow allows me to wait, allows me to pay for a boat, allows me to pay for a house, allows me to pay for a vacation. It allows me to do things in life that I want to do while I wait and we increase the EBITDA, while I wait and we increase the NOI over time through inflation, through our efforts, through how we're running our business and treating our people and the type of employees that we're getting, for the customer service that we give, right? Because over time, this real estate is going to increase the NOI just through natural inflation. Even if you don't do anything right. If you have a long-term mindset and can hold this for 30 years, I mean, over 30 years, this NOI, just by the inflation alone, probably turns into about $2 million, $2.5 million NOI, and I think that's being really conservative, right? So now you've got a $40 million or $50 million value while you waited and got paid that whole time. But don't ever forget about this. This is why in real estate, I want to keep taking care of the asset. If I have to pause distributions because we're going through a rough time, I always want to be able to keep our staff there so that we can operate it. I always want to keep, care. I want to make sure the roof is good. I want to make sure that, the asset is not losing integrity. Because if I don't take care of the asset, then over time, this cap rate will actually go higher, right? Which if a cap rate goes higher, that means the value is going to go down because the next buyer is going to have to come in and put a lot of money into it, right? And if they're going to have to put a lot of money into it, that's more money they're going to have to invest other than the upfront investment of just getting control of the property, right? So I'm always trying to take care of the property so that when we go to sell it, there's very little big time capital expenditures that they need to do, because then what's going to happen is I'm going to get a more compressed or lower cap rate on the NOI, which then drives up the long-term value. So you need to be aware of this. You need to think, when you're a business owner, you need to think, what are the value of my shares? What's the value of the business long-term, not just cash flow. Cash flow is important. It's the first thing I'm always looking for. But then the next thing is, okay, how can we put more dollars, invest more dollars? What can we do better here to increase the overall value, to then not only get the cash flow, but through the life of the deal, but then to get a big bang at the end. The biggest bang, the most bang for our buck that we can get. Thank you for tuning in to the Want to Know Wednesday.